Stephen, earlier in our conversation, you brought up Barney Frank. When people see headlines like bank collapses, they get 2008 flashbacks. So, do you think these bank failures signal that we could be seeing another great financial crisis?
So I don't think so. It seems like the market has responded well to what the Fed, the Treasury, and the FDIC did last night to stem the bleeding, at least for now. That said, I do think it's very important to understand or appreciate the danger of a situation where, again, two banks that most people have never heard of failing in California force these emergency actions because of the concerns, the reverberations that would have come today had they not guaranteed deposits, had they not guaranteed deposits from Silicon Valley Bank and then subsequently a Signature Bank, which was closed on Sunday night. And I mean, to me, that is a big cause for concern. I mean, these are not too big to fail banks, but at the same time, they were too big to just let go. And regulators and basically all interested parties are going to have to figure out a way to sort this out so that one or two banks collapsing does not create a global financial crisis again. I've seen some calls. I mean, I think Bill Ackman actually put out on Twitter that basically almost all deposits north of the $250,000 FDIC limit should be guaranteed by the government. I mean, that's a different way to go. And to me, that's also a very slippery slope because at that point, I find it hard to believe that such a guarantee could be made if one was necessary that would not expose taxpayers or taxpayer dollars to risk. And it's important to note that in this particular case, it appears that no taxpayer dollars are at least directly at risk. And two, if we get to that point, that it's a slippery slope, I think, to nationalization of the banks and the government starting to have a say in decisions and strategy and so on and so forth. And there's more than 3,000 banks here in the U.S. and we have a very diversified financial system because we're such a large country with so many different types of needs. Like I don't think it makes sense for J.P. Morgan to be giving a small loan to a farmer based down in Iowa. And what we don't want to see happen either is for basically all money to just flow up to these tier one banks, or at some point, especially if we start launching a digital dollar or something like that, folks ultimately opening up accounts or retail accounts at the Fed, which is something only commercial banks can do. So there's a few different ways that this could go. I don't think I'm not so worried about a major crisis right now, although we're gonna have to wait and see what happens in the next couple of days. But it's important for everyone to be surgical in their immediate response to this right now so they can stem contagion long enough to rebuild the regulatory infrastructure to ensure that, again, a small spark somewhere doesn't create a fire in another part of the world.
I like what you just said. Everyone needs to have a surgical response. Today, as we sit here, it seems a bit more contained than Friday. Over the weekend, it seemed like alarm bells were really going off. Now it seems a bit more contained. So what's next here? What is the surgical response that you would like to see?
So what's next is I think it's important for all federal regulators to kind of stay on their toes, be ready to act when necessary. I know that these emergency actions on Sunday night were difficult for certain people to swallow. Rightly or wrongly, they see this as something akin to a bailout for the tech sector, for venture capitalists that on kitchen tables all across the country see as exacerbating wealth inequality, profiting from all those COVID largesse. They don't always necessarily see that other victims would be the employees of these startups that were not necessarily or may not have been able to make payroll. But regardless, it's important to stem any contagion for right now. And then it's gonna, and I think President Biden even said it in some of his comments this morning, we're gonna have to rethink how our financial system is regulated, because there's no bank that there really should be no bank that is too big to fail, and there should be an easy, simple way to orderly wind down a bank that is financial trouble, while not letting that those problems metastasize to other parts of the country. And I think too, and one thing I also don't lose sight of is that this was very much like 100-year pandemic of 100-year flood. These economic conditions that we're operating in are unprecedented for virtually anybody that is alive right now. There are very few economic rules, excuse me, the laws of economics really don't apply right now. Case in point, in some ways, in a perverse way, we're almost rooting for employment to go down so that the Fed gets confidence that its interest rate hikes are starting to slow down the economy. I mean, that's a perfect example of it. But at some point, serious thought's going to have to be given into how banks assess their risk, what they are allowed to do with their deposits, and yeah, I mean, just figuring out a way to make the financial system more anti-fragile. And one other small point I'll make too is I would like to see some of the crypto-focused banks, in particular the two from Wyoming, Custodia and Kraken Bank, be allowed to launch. These two banks, in particular, would be immune to the problems that impacted Signature and Silicon Valley and Silvergate because their charter explicitly prohibits them from rehypothecating assets, buying bonds with assets, or essentially playing the interest rate lottery. They more or less would just have to keep money that was deposited in the account, try to make up their funds from fees and some other things like that. So there would actually be some questions about how those banks might be profitable in the long term, but at least from a customer safety point of view, the risk would be much more straightforward. So maybe that is one option that could come out of this.